Before a trade is placed, you are an observer. You sit in the quiet, evaluating the data and reading the structural patterns of the market. Logic and pure strategy lead the process. This chart shows a steady upward trend, forming a standard, healthy market structure. Looking at this data objectively, you can identify a specific, logical zone to place an entry, based entirely on mathematical probability. You formulate the plan, you wait for the setup, and you execute. You click the mouse with complete confidence in your analysis. In this pre-entry phase, your perception of the market data aligns with mathematical reality. Because no capital is at risk, your analysis is free from emotional distortion. The moment the order fills, you become a participant. The market takes its next breath and naturally begins to retrace. Instantly, your posture stiffens. Your heart rate climbs. A few seconds ago, you planned for this exact pullback. Now, sitting in an open position, you feel an overwhelming, visceral urge to exit the trade immediately. Look at this chart again. Nothing about the structural trend has broken. Yet, as a participant, you process that minor dip as an aggressive threat. You are reading the exact same data completely differently. The presence of financial risk shifts the brain's focus. You stop looking at the total structure and begin scanning for immediate threats, which changes how you interpret the visual evidence on your screen. Psychologists classify this perceptual shift under a specific mechanism: loss aversion. This response is a survival trait hardwired into the human nervous system, designed to protect us from perceived danger long before we ever encountered a trading platform. This visualization illustrates the central rule of loss aversion. Due to our biological wiring, human beings experience the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain. When mapped onto a financial market, this hardwired asymmetry creates a severe blind spot. The brain misinterprets neutral, everyday price fluctuations as existential dangers. Once you transition from observer to participant, your nervous system automatically prioritizes immediate survival over objective statistical analysis. Taking ownership of an asset creates a condition known as position bias. This bias acts like a lens, skewing your interpretation of any new incoming data. This is a zoomed-in candlestick chart. Through the lens of position bias, a minor red candle that represents healthy market breadth is processed by the brain as an immediate, flashing emergency. This sudden state of threat perception kicks confirmation bias into overdrive. Your brain actively scans the environment, looking for evidence that justifies its newfound fear. You begin checking lower timeframes and spotting bearish patterns that aren't valid, ignoring the wider, bullish context of the trend. If you attempt to process new data while trapped in this state of threat perception, the biological, emotional reaction will consistently overpower your logical plan. You cannot rewire millions of years of human evolution to turn loss aversion off, but you can use strict process behavior to bypass it. The solution requires a mandatory, practical rule. You must establish your exit logic before putting a single dollar at risk. We call this the invalidation condition. It is the exact, predetermined price point or structural break that proves your original trade thesis is mathematically wrong. You commit to the physical act of writing this condition down. This externalizes your logic, creating a static reference point that remains unchanged even as your internal emotional state begins to fluctuate with price. This written rule serves as an objective anchor. It locks your logical decision-making safely in place before the fog of loss aversion has a chance to set in. When the inevitable pullback happens and your brain screams threat, you no longer have to interpret the chart emotionally. You simply pause, look at the sticky note, and check if the condition was met. Trading discipline comes from a reliance on pre-established processes. These systems are designed to maintain execution quality at the exact moment fear begins to influence your decision-making. Before your next session, keep this question in mind. Did the chart change, or did your emotional exposure change?